And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It is a confusing moment for all of us. As we enter June, fund flows, they're just all over the map. Where's the money going now? And what's up with the retail trader? Let's talk with Anthony Denier. He's the CEO of retail trading platform Webull. Nicholas Cole is my old friend, co-founder of DataTrek, who will update us on ETF flows and give us his outlook on earnings in the second half. Anthony, most traded ETF on your platform, I have been noting this for weeks now, not on your platform, but everywhere. Ultra short QQQ, symbol SQQQ. This is 3 times the inverse of the S&P 500 on a daily basis. And normally you see the S&P 500 funds most actively traded. Why have retail investors suddenly embraced leverage in inverse ETFs, particularly the NASDAQ 100 ones?
Right. Well, NASDAQ 100, as you know, is very tech heavy. Tech heavy seems to be what our customers are into trading, right? It's the ones that move intraday, right? It's less boring, to put it that way. And I think there's a couple different reasons. One, I don't think is talked about enough, is the retail investor, the average account went from 5,000 to now averaging about 3,000 on a platform like Webull. That would also apply to a Robinhood type investor. They sometimes won't even qualify for leverage in terms of utilizing margin because of their account balance. So they're utilizing these leverage ETFs to make up for their account being downgraded maybe from a margin or to a non-leverage margin account or possibly even only a cash account to trade their stocks.
Yeah. So, Nick, every day, the most actively traded ETFs in terms of shares traded are what we talked about, that SQQ and the TQQ, which is the other side of the whole thing, 3 times leveraged on the triple Q. SPY is still the largest in terms of dollar value, but I see $5 billion in notional trading of SQQQ every day. I would have thought professional traders would be using these, but Anthony says retail traders are starting to use them now. Is this a sign that retail is pessimistic? What do we take away? Is there a risk about all of this use of leverage and inverse ETFs around triple Qs?
No, I think from a market standpoint, it tells us that a lot of retail traders are trying to claw back maybe some losses from earlier in the year. They're down, they want to get back up, and so they view the riskier bets as the most efficient way to try to claw back some of those losses and get back flat on the year, even make some money. So I think what we're seeing is a really interesting adjustment in risk tolerance. You'd think that when markets go down, risk tolerance goes down. For a lot of accounts, for a lot of clients, it goes up, and that's what we're seeing here.
So the risk tolerance is going down, you think?
Risk tolerance, as far as how a long-only investor would think, maybe is going down. Hey, I want to be out. That's what we see on the fund flows. But for a trader, somebody who wants to make money in the market, you got to take your risk tolerance up in order to make that money back.
Yeah. You know, the fund flows have really been confusing me recently. I follow them, and they tend to I think they tend to mean something at extremes. The problem I have here is, let's look at the flows here. April, we saw peak outflows. It changed in May, but it's still not consistent. So I see inflows into the S&P 500 and outflows in energy here. That's kind of interesting because energy was the big outperformer in May. I'm not sure what to make of this. And then on bonds, I want you to comment on this separately. We see modest inflows after huge outflows earlier in the year. So tell me what you're expert at making sense of fund flows here. I want to just address equities first.
Sure.
What is this trying to tell us?
It tells us primarily that investors are pulling back. And the energy point you made is really critical. Energy XLE was up 17% last month. Made a lot of money in that name. People were pulling back because they're pulling back on risk exposure generally. On our tracking of these fund flows, the money seems to be going directly into consumption. It's not going to bank accounts, it's not going to money market funds. It's being used primarily for consumption in an inflationary economy. So that's where the money is going. And as long as inflation is high, that's going to be, I think, the trend that we see.
But the trend follower in me says, gee, energy is the biggest performer of the year, and yet we saw some modest outflows. You'd think there'd still be money going into it. I'm trying to sort of make sense about it in the traditional way I understand trend following, for crying out loud.
You coined a marvelous phrase in the last decade, the most hated bull market in history, right? Why was it? Because flows were negative and stock prices kept going up. This energy rally is turning into the most hated sector rally of this year. Yeah.
Anthony, it looks like the active trader is still pretty active. I see that in your numbers, but you've told me separately that the fair weather trader is gone. I love that phrase, the fair weather trader is gone. Explain to us what that means when you say the fair weather trader is gone, the active trader is still there?
I mean, the equity markets for the past 10 years has been operating with a lot of tailwinds helping it along, especially for newer and less experienced traders, right? It was basically buy, stock goes up, buy more. Obviously that has changed over the last several months. We're entering bear market territory, and there's a lot of traders that have never seen a down market, and they've been burned, and they just walk away. And these are not necessarily traders that aren't long-term investors, but these are traders that thought they could make money actively trading.
Yeah.
Right. So those are the fair weather traders I talk about. I don't want to differentiate, right? They're still investors, but not the traders. Active traders still remain very, very active. I mean, short sales alone, we're seeing up 400% this quarter on our platform, right? Which, compared to last year, that's an active trader utilizing this volatility.
But I'm looking at the numbers here. Average assets under management, $5,000 a few months ago, and now $3,000. Mm-hmm. So it looks like, what do you call them, the self-directed trader, whatever you want to call them. It seems like they're having a rough time of it right now.
Yeah.
So you run a business, you run a trading platform. What are you and other trading platforms, what are your competitors doing to keep people on the platform? If not actively trading, what do they do? What are you doing to keep them there?
Well, like our customers, we're new, right? So Webull's been around for 4 years. We're evolving and maturing just with our users. So we started off self-directing. We're now offering products of recurring deposits, recurring investments, and we're soon going to be rolling out more passive investment options, right? Not everyone is happy looking at their phone 12 hours a day nonstop trying to chart or time a market. A lot of people, especially with these volatiles, would rather kind of set it and forget it.
Passive, my heart leaps when I say passive, because I'm a Jack Bogle guy, as you all know. But what does that mean to you? How do you encourage people to do passive investing from the active retail environment we've been seeing for several years?
Offer easy to navigate portfolio building indexing tools that customers can then create to their own risk assessment profile and then actively invest in that on any given period of time that is sufficient for their own budget.
Portfolio building index tools. Mm-hmm. I mean, this is an amazing thing to hear from retail trading platform. Nick, is this signs that the retail traders are evolving in the way they look? I'm hearing talking about passive investing here from an active retail trading platform.
Hey, look at our generation. We grew up in the 1990s trading tech stocks. Then they blew up. Then we realized we got to get serious. Start putting more into the 401k. Start putting more into personal investments. Understand indexing and passive investing. Every generation goes through the same evolution, I think, starting with an exciting bull market, but then realizing this is a very long game and you got to play it as a long game.
So it sounds like it's time for a lot of younger traders to grow up and think a little bit longer term.
Just like we did.
Yeah. Yeah.
Right.
Well, it happened in '99 and 2000.
People grew up fast.
Yeah. For doing that, that's for sure. Nick, tell me where you stand on the markets right now. You're one of the great market watchers out there. Puts out, those of you who don't know, DataTrek puts out an outstanding daily newsletter. You're sort of you're not a quant trader, but you use quantitative analysis for the stock market. You analyze massive sets of databases and look for clues. You mine for clues. What do you see happening in the markets right now? The big question is, are we going to avoid a recession or not?
Yeah, so the short answer is we're in for some more trouble. We got two problems. The first is oil prices. Seem to still want to go higher. At 140, they're a double year over year. That's the signal of a recession coming. It always happens. When oil doubles in a year, you get a recession in the next 12 months. So that's the thing to worry about. My other concern is earnings expectations are way too high for the back half of the year. We've been doing $54 a share in S&P EPS every quarter for the last 4 quarters. The street's at $60 and $61 a share in the back half of the year. Those numbers have to come down. They're just irrationally high. And the market understands all that. The market's discounting those already. But until we see earnings cuts and continued growth and oil prices come in, I think we're in for more trouble.
I honestly don't understand this. I've been watching the markets for 25 years as the stocks correspondent, and I am amazed they have not taken the earnings estimates down this year appreciably. So we're still looking at 10% earnings growth for the S&P this year, another 10% in 2023. And so the decline in the S&P 500 this year is entirely due to the multiple being compressed. It's not the earnings actually going down. If earnings go, I think it's 228 now we have for the S&P from 208. If we go flat, on earnings, that would imply another potential 10% down leg in the market. That's how a lot of these strategists get to 3,400 really quickly. But you were an analyst, right? You write about this all the time when you were an analyst. Why aren't they? The market seems to believe that they should be taking the numbers down, that the estimates are too high for the second half of the year, even if there isn't a recession, and yet they're not doing anything. What is it that everyone else sees that the analysts don't want to see? Or is there a lack of creativity among the analyst community?
No, the analysts really want the guidance of the companies before they cut numbers. They don't want to go out on a limb and cut a number that the company will say, why are you putting out this low number? It's that feedback loop between the analyst and the company that prevents the right numbers coming out.
But what's the value of an analyst if the only thing they're going to do is, we're not going to do anything until the company guides us? Who needs that? There used to be a lot of more independent thinking on Wall Street.
There was. Look, there's an old saying about analysts. In a bull market, you don't need them. In a bear market, they'll kill you. We're in the second part.
Yeah. Remember the 2003 analyst settlement, the global settlement that Spitzer did? Spitzer correctly called out the conflict that existed, sued the community, and came to a deal. And what I saw after that, you tell me, you were around, the brightest left. On the sell side analysts went to the buy side. Some of them tried to set up their own shop. I saw pay dramatically drop. I saw a lot of people making $1 million plus a year in 2003. I don't know what the average pay for a sell side analyst now is, but I'll bet you it's probably $300,000, somewhere around there. So the best and brightest left. The pay dropped dramatically. And what I see, this is a broad statement, so forgive me, the intellectual quality of sell-side research has declined dramatically. I get most of the street's research on a daily basis, and a shocking amount of it is garbage. There's no real value in it. My point is there was more creativity, outside-the-box thinking, and, meta-analysis, whatever, than there is now, where you correctly point out they're just waiting for the CEO to tell them something. So I'm editorializing on here, but I feel very strongly about it. If we believe, direction of earnings is important for the street and where prices go, and analysts are just no longer doing anything, the whole model kind of gets called into question here. The street starts moving independently of the analyst community. Yeah, no, that's true, but at least the market discounts it before. So at least asset prices are being correctly set. What we're seeing right now is that worry. And by the way, the market peaked out at 33.87 in February 2020. The S&P is still 20% higher than that today. Every other global market is below its February 2020 levels right now. So we're outperforming, dramatically. Although I did note in May, Europe did a little bit better. I think we were up 1%. China was up 1 or 2%. S&P was 5%, but that's a pretty small dispersion. It was pretty even overall. It's kind of, everything kind of flattened out second half of May. I had exactly the same thought running the numbers last night. Everything's so tight. A little bit here, a little bit there. EFA was up 2, EM's up 0.6, S&P and NAS are flat, or S&P and Russell are flat, but still very tight. And it's tight year to date. What does this mean for your investors? Do they pay more attention to things like earnings, or are we actually sitting around saying, the active traders are more interested in momentum trading, classic momentum trading?
So they'll look at earnings when there is momentum behind it. I mean, on our platform, we also offer analyst ratings for customers or our clients to look at for every stock, right? And this is this is not naming Goldman Sachs, JP Morgan. It's an average of all analysts across the street. It's one of our least looked at pages on the platform. Really? So retail investors, at least active retail investors, are looking for that momentum. They are playing earnings, but not taking sides because an analyst says so, taking sides because of peers. And because this is an ETF show, I want to get your thoughts on sectors, because that's what people trade the most. Give us your view on sectors in the second half of the year. Is energy going to continue? Give us some large macro themes here. Sure. So, yes, we still love energy right here. I think it still has a lot of room for multiple expansion, and the numbers are going up. Unlike the conversation about the market as a whole, where the numbers have come down, ExxonMobil, Chevron, all the energy names, estimates are rising. So energy is fine. A lot of our customers are looking for safe havens, and for us, it's healthcare, like the XLVs, the large healthcares of the world, because when growth investors can't buy tech because it's been imploding, and can't buy retail because that's also not doing well, the only
third road left is healthcare. And we see this over and over and over again. Every cycle sees healthcare as a percentage of the S&P peak at the bottom of the market. Happened in 2000, 2002, happened in 2009 and 10. We have another point or two to gain with healthcare. So that's got multiple expansion in it as well.
But
those are the
we
two
saw this
sectors.
every day. I mean, Lilly last week new highs. Merck was at new highs the week before.
Yep.
You know, Bristol was stronger. So all of that is playing out exactly like you're saying on the playbook.
And it will continue to do so as long as we have these worries about recession. Numbers have to come down.
So do we avoid a recession? I'm sorry to hit you with such macro stuff. It makes you uncomfortable, but that's what people want to know. Tell me if there's a recession, and I'll tell you if we're at some bottom right now.
Tell me if oil goes to $140, and I'll tell you if there's a recession. Because if it
goes to 140?
140.
And that's the doubling that you were talking about?
That's the doubling, yes. In the current environment, I don't see a way to avoid a recession. If Russia-Ukraine solved that war and oil prices came back down below 100, we could easily avoid a recession. In the current environment with current trends, very hard to see.
So you think there's a good chance oil goes back over 140?
Yeah.
Because?
The last peak at 140 was July of 2018, right around July 4th weekend, which is peak summer driving season. And we're heading there right into exactly the same setup right now.
That's a good point. Anthony, any final word here?
I just think people aren't looking at the macro version of what happens with China-Taiwan intervention. I think there's a lot more rain down the road, so I think we need to be cautious.
On Taiwan, China, you said?
Taiwan, China, yeah.
Do you think there's chances for conflict in 2023, for example? I mean, is there?
It's going to look different than Russia invading Ukraine, but from conversations I've had with people overseas, it seems like China is definitely going to make some sort of headway into Taiwan by the end of this year, maybe even next year. And that's something we're not even talking about in this macro environment.
Yeah, that would certainly be another kind of game changer. How would that change the world?
Well, then you got global recession for sure, and a pretty deep one. And forget about electronic supply chains, right?
Yeah. So the probability of this, you think, are fairly high? You think so?
Maybe talk to Ian Bremmer on that one.
Yeah. Well, that's an important point here. This is another potential, not a black swan event because it's a known unknown. It wouldn't be an unknown unknown. That's actually weighing out there. All right, gentlemen, thank you very much. Folks, I know we've gotten a little macro today, but it's important to get that sense of perspective. And when you have somebody like Nick Colas here that has a very broad view of the world. So that does it for this week's ETF Edge. My thanks to Anthony and Nick. We've asked Nick to stick around for the ETF Edge podcast to give us additional views on the market. Remember, you could see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.